Morning, everybody. I think everyone is still rolling in, but we have a very full day, so we're going to get started, and people can jump in as they get here. Welcome to COCPA's Member Appreciation Day, CPA CPE on the house. We're excited to have you. Today will be an opportunity to earn up to 10 free hours of CPE. I think that's a pretty strong ROI for your membership. My name is Daryl Moorhead, and I am COCPA's Director of Member and Business Development. This free CPE today is being offered as a member-only benefit by 10 companies that have chosen to be preferred partners with the Society. Our partners are key to making these types of events possible. Their time, their resources, and their financial commitment to the COCPA allow us to provide valuable content, resources, and in this case, free CPE to our members. Isn't free CPE a great member benefit? I think it is. Thank you to all of our preferred partners for supporting this event. I encourage all of you in attendance today to take the time to thank our partners when you have the opportunity, or better yet, hire or refer them when you have the chance. If you have any technical issues throughout the day, some of you have been on earlier, working with Tiffany in the background. But if you have any technical issues throughout today, please click on the participants list, choose Colorado Society of CPAs, then click chat. This will send a direct message to our tech team. If you have questions for a speaker, please just put them into the chat and make sure you are chatting to everyone so that we can all see the question. I will jump in throughout the day and share those questions with our speakers. Materials are available in the purple box in the event lobby. So as Tiffany mentioned to some of you earlier, you'll return to the event lobby after each session and then enter the next session from there. Returning to the event lobby and then entering the next session allows us to keep the flow of your CPE cleaner for all of us. And it makes it easier on the back end so that you get your proper credit and your certificates. Please make sure you're paying attention to those attendance checks. These will pop up randomly while you're watching. You must answer 75% of them to get full credit for the course. We will also make a note in the chat box when the questions are posted. If you do not see the polling questions, please send a direct chat to Colorado Society of CPAs, and our staff will work with you to get that issue resolved. In addition, our team will be monitoring these checks. If they did not see that you are checking in, they will send you a direct chat message. So please keep an eye on the chat. Each session will have its own survey and certificate. Finally, an issue was brought to our attention recently. You may not be seeing the whole video window. If you are seeing chat boxes over the side of your video window, or if the chat boxes are in your way, hover over the top chat, then click Clear All. All right, so let's get this program started. Our first program features our newest preferred partner, Integrated Financial Partners, and they will open our day with a session on tax planning now, year end, and into 2024. Please watch the chat for additional information about each of our partners throughout the day. I want to thank John Pastore, who's on in chat, who is my contact at Integrated Financial Partners. They have a great program that I think all of you will be interested in. And our first speaker, also from Integrated Financial Partners, is Richard Austin. Richard has the mind of an attorney and the heart of a financial advisor. He consults with high net worth clients, business owners, and Integrated's network of financial advisors on estate planning, charitable planning, business succession planning, and tax planning strategies. Armed with more than 20 years of industry experience, Rich previously served as vice president at Lincoln Financial Advisors and a staff attorney at the AYCO company. He is also one of the highest rated speakers for the Massachusetts Society of CPAs. So we're happy to have him here today in Colorado. You can find his full bio in the materials. And with that, I'm going to turn it over to Rich. Thanks, Rich.
Thanks a lot, Daryl. Appreciate it. And good morning, everybody. John, are you on?
I am. Good morning, everybody. Can you hear me? Well, Daryl, thank you for that warm welcome, and we are so proud to be partners with the Colorado State Society, and thank you to everybody for waking up so early today to be part of this event. Okay, we're getting some chat room that people can hear us, so that's great. We love it when you can hear us. The the event always goes better that way. Daryl, thank you for welcoming us into the society, and thanks for having us here. Today is a real treat. We're just glad to introduce ourselves to you. We're happy to educate, and tomorrow is December 1st, right? And with December 1st, comes a lot of opportunity to do some year-end tax planning. We know that we can't affect 2023 and 2024. Let me tell you a little bit about Integrated. Our name is a description of what we do. We work with hundreds of CPA firms all over the country. Either we have friends of the firm where they use, people like Rich, who is, one of our best and brightest, as a resource, or they partner with our advisors in what we call a co-source methodology. The co-source methodology is where we put an advisor into the CPA firm. And for those that are trying to offer financial services, we do all the work. We're independent. We're multi-custodial. We check every box, working to a fiduciary standpoint, and share the revenue with our partners 50-50. It's been wildly successful. We just came back from the Mass State Society of CPAs, where one of our two partner firms shared how they were successful in bringing in over $900,000 of reoccurring revenue. And we have many, many stories like that. We work with sole practitioners to some of the biggest firms in the country and everything in between. And you'll see today we take a consultative approach instead of a sales approach, being that we're independent. So today, we're so excited to showcase one of our key people, Rich, who is, as Daryl explained, a magnificent blend of financial services experience, tax, and estate planning. And what he wants to do is load your lips with some great ideas as you meet with your clients in what might be one of the most important months of the year. So thank you for having us. And with that, it's my pleasure to introduce my friend and soon to be your favorite, Rich Austin.
Thanks a lot, John. Thanks, Daryl. And I'm really glad to be with you this morning. I have a benefit. I'm on the East Coast, so it's 2 hours ahead for me. So I know I'm competing with your treadmills and your breakfast, and but that's okay. That's good. You should. And that's the Zoom world that we live in, right? So this next 50 minutes, 45 minutes is really going to be around a practical presentation, conversations that you can be having, with your clients. And so I'm going to go through a reminder of tax legislation that was put into place in 2022. Just a few points on that, talk about some tax strategies. And really the way I break it down is with different clients, different conversation starters, if you notice an opportunity, then this is a situation that you can, or a solution that you can talk to that client about. So it's really just going to be a practical presentation. Daryl, I love the change of the backgrounds. Thanks. And then we'll go through those different strategies, and then throughout, I'm going to, if there's some questions, John's going to be monitoring the chat room, and I'm going to try to answer, a lot of your questions throughout the presentation. So let's get started, and don't push yourself too much on the treadmill, okay? So legislative updates. So what we, what we saw in 2022. Was there was an outside of the administration, you had coordination of, of the House of Representatives and the Senate, which was, that was controlled by the Democrats. And so in 2022, there was a lot of initiatives that were to be put into place. And we saw the Inflation Reduction Act, passed in 2022, and we saw the Secure 2.0. Because Secure 1.0 wasn't enough, passed in 22. I'll go through some of the provisions in there because, like I said on a call yesterday that I was working with, some of our team members, it's hard to keep, up to date, maybe it's just me getting older, but hard to keep up to date with like all the numbers and where they're at, because I feel like they just keep on changing, more often than not than it was 10 or 15 years ago. But what happened in 2023 was in this year was kind of a lull, and not a lot of different tax legislation, not a new legislation that was passed. And really what you saw was the Democrats losing control in the House of Representatives, which kind of stymied, their progress. So if you look at the Inflation Reduction Act, really what that was, the most significant provisions were hiring 87,000 new IRS agents. And so, and what we've seen there, and and what we've heard from that the IRS is going to be doing is they're really going to be going after the highest, income, taxpayers, and specifically they're going to be, going after the largest, corporations and partnerships for discrepancies that they've seen in their tax returns. And go into a little bit more on that in a minute. But the other, big pieces in the Inflation Reduction Act were for corporations, poses a 15% minimum tax on corporate, book income, and 1% on excise tax on stock buybacks. And there were a lot of energy provisions for homeowners, electric vehicles, and business owners. When we look at the Secure 2.0, here we had a lot of provisions that made changes, to or added benefits for qualified plans. For example, and starting in 2025, we're going to have expanded automatic enrollment, for employees, in qualified plans. So that'll be interesting to see, the opting out and getting that in place, with our clients, with qualified plans with their employees, for levels with contributions with levels between 3 and 10%. And then the required beginnings, the required minimum distributions, the required beginning date, raising that to age 73 beginning this year in 2023. And then here was a big one, bringing the 401ks and similar employer plans in line with Roth IRAs. So the legislation actually eliminated the requirement for savers to take minimum distributions from their workplace Roth accounts. That won't start until 2024. And then you have the expanded qualified charitable distributions, which I think is a great opportunity at different income levels. And we'll talk about that strategy later on, using IRAs, required minimum distributions for charitable purposes. So the amount for the QCD from an IRA is $100,000. That needs to be from, married filing jointly, 100,000. If both want to do 100,000 or some portion of it has to come from their IRA. It can't be $200,000 from one IRA from one spouse. And then there'll be rising catch-up contributions. Individuals who are age 50 and older can make additional catch-up contributions of $1,000 to their IRA. And starting in 2024, that's going to be indexed. There was some new penalty exceptions that were put into place that were pretty, in my mind, they're very broad, for early withdrawal and avoiding the 10% penalty. And it applies to emergency personal expenses, terminal illness, domestic abuse, pay long-term care insurance premiums, and to recover from a federally declared disaster. Seems pretty broad. So it'd be interesting to see how that's interpreted for IRA participants who are younger than age 59 and a half. And one of the other new ones is the law permits employers to start matching in Roth accounts, which wasn't available beforehand. And also for 529 plans, there's the ability to directly roll over from a 529 plan to a Roth IRA for the participant one time. Right now it's at $35,000. So that's a planning opportunity for our clients that have excess funds in the 529 plans and not sure what they want to do with that. They can set up a Roth IRA for their children and roll over those funds. So one of the things I just mentioned before, was the IRS, hiring new agents. So some of the funding was, was used elsewhere. So they don't have the full funding for the hiring the full 87,000. But what they have done is they're targeting large partnerships, S corps and millionaires. So, they kept true to the promise that they weren't going to go after, our clients that were making under $400,000 a year, right? So, which is good. But they did announce that they're shifting their attention to the wealthy taxpayers over $1 million. They're using artificial intelligence. They're, looking at, inconsistencies in tax returns, in different years, especially with the reporting of, of assets and, between, with partnerships and S corporations from one year to the next. And so they were going to be targeting supposedly this year 75 of the largest partnerships in the United States. So I haven't heard an update on that, but those partnerships on average have more than 10 billion in assets. So none of them are my clients, but I thought it was a good point to kind of bring up. They might be yours. So on the ledges, one of the other reminders that I wanted to give you was on the Tax and Jobs, Act, that there's a cliff, and we've talked about it for a while, right? So end of 2025, certain provisions revert back to the law as it was in 2017, obviously indexed, for inflation, and we've had some high inflation years. So, and some of those provisions were individual tax brackets. We're going to take a look at that. All of these are things that all of you know, but it's a good reminder to kind of think of it from like a planning standpoint, with clients, because sometimes we just get, in the weeds and kind of doing the compliance piece or, checking things off the list, but there's planning opportunities with clients. So the individual tax brackets, expanding those to seven brackets, there's a bracket management, opportunity. The child tax credit, which was increased, AMT, in coordination with, raising the standard deduction, and then reducing the application of the alternative minimum tax, but then also reducing, putting limits on the amount of home mortgage interest and, and state and the deduction of state property taxes limited at 10,000 with a limitation on state income taxes. It kind of, in my opinion, it kind of was a wash, in a lot of situations for that upper middle class taxpayer, with not having to pay the AMT. From my opinion, honestly, like, when I looked at my own tax return and I saw that I wasn't in AMT anymore, it always was painful to pay the AMT, but since it came out to the same, it just seemed less painful that you didn't have the numbers on the AMT line. I don't know if your clients feel the same way, but that's how I felt. Miscellaneous itemized deductions, there were a lot of limitations that were put on there, especially for a lot of our clients with investment advisory fees. It really started to bring up the conversations between, the work that we do from a consulting standpoint and advisory and investment management, and kind of bifurcating some of those fees, especially with our business owner clients, where sometimes there's a consulting fee that's paid for the tax planning piece or the financial planning piece as compared to the wealth management side. And then, the piece limitations, moving expenses, student loan and home mortgage discharge, section 199A. That was a big one. That was, I think I have a chart later on that's kind of like, that you've probably seen before, but in essence, 199A was the, was the IRS's attempt at taking flow-through companies like S Corps and LLCs and putting them in line with C corporations, with reducing the rate down to 21%. So, putting service companies aside, a qualified business, income deduction, at 20% of qualified business income, is pretty meaningful. But that's gonna, that goes away at the end of 2025, and along with the rest of these provisions, unless Congress acts and extends it. But with the increase in the budget deficit and everything that's going on, I, in my personal opinion, is I don't think that that's going to happen. But I have been wrong in the past, and things happen that you just kind of, shake your head and you're just like, how did that happen and why? Estate and gift tax exemption. By the end of 2025, you have estate exemptions from a federal standpoint that are over $13 million. So getting reduced back in half, back at the beginning of 2026. So if you have clients that are subject to federal estate tax, there is an opportunity to do some planning with them, and to use some of those exemptions. But it's unless somebody's not using their full exemption, unless they're worth probably over $30 million, let's say. It depends on each client situation, what the assets are and how they're gifting it, and how much access they keep to it. But there's it's not the worst thing in the world if they don't use it. But if they have a large enough estate, why not use it? That's, those are real dollars. And we can set it up in a way where you still, if you're married or spouse, there's enough flexible provisions that you could put into a trust where you can irrevocably give it away, but still have some access. All right, let's get into bracket management. So I like this slide because it puts on one page the different tax brackets for married filing jointly, single, head of household, and trust and estates. Sometimes we forget about the trust and estates and the trust, and we use a lot of grant or trust, with our clients, but you can see you get to that highest tax bracket pretty quickly. But there is an opportunity with clients, depending on state income taxes and where they are in their tax brackets, to really kind of look at, does it make sense to turn off some the grantor trust status and make it a non-grantor trust? You give up a lot of flexibility. That's a different conversation, but I think being aware, of the tax savings and quantifying it and see if it's worth giving up that flexibility. But you can see the 7 brackets here, and that was always interesting to me, and it's a reminder because I literally forgot that you're in the 15% capital gains bracket, through married filing jointly up to $550,000 of taxable income, which, is, you just remind yourself that that's, we're in a low, the taxes that we have from a federal income tax standpoint and from capital gains standpoint, estate taxes, if I pull up all those charts and look at it historically, they've been much higher. There's an opportunity for clients at lower tax brackets today. And I think it's worth kind of reminding clients about that. Bracket management strategy. So, this is more from a distribution standpoint. So the goal of planning is kind of like looking at, if we have clients that are, 0 to 12%, and a lot of this would be our children of high net worth clients, taxable, looking at the yields between a taxable yield and a tax-free yield, the taxable is probably the winner. And then from a capital gains standpoint, we have clients that are making annual exclusion gifts, to their children. They have low basis stock that maybe they're going to sell, or if the children sell at their tax brackets, it's a 0% capital gain. If they're in the 0, 10, or 12% bracket. Business owners, shifting with children that are working in the business and shifting, income, to children. I know this has been talked about for, all the time, but that's a real opportunity done the right way. Then you start to get up into the 22 and 24% bracket. And remember, like married filing jointly, 22 to 24, we were, 24 is getting up to $364,000 of combined income. I was just on a call with a client the other day, and we were talking about bracket management, and he was trying to stay in the 22% bracket. I reminded them that, I said, it's not my money, but a 2% spread from 22 to 24 is not the worst thing in the world, and that's going to change in 2026. So maybe it's not a bad thing. And it's just kind of a reminder. It's not just it's trying to get out of that next bracket. Maybe going into it, maybe it makes sense. And then from a distribution standpoint, we're looking at, as, clients that are taking distributions from qualified plans, so having a balance of Roth IRAs and traditional funded plans that are taxable when the funds come out. for bracket management later on is the best situation that you want to be in. I mean, unless you can make it all Roth, but maybe that doesn't always work perfectly throughout business owner or an employee's lifetime. And then the use of life insurance. I'm sure you've heard, rich man's Roth but life insurance is an asset that provides income tax, benefits that aren't available in any other, asset class. I mean, there's tax-free deferral, and then through withdrawals and loans set up the right way, there's tax-free withdrawals from there, tax-free accumulation. So it's, an access to clients and they fund it. Now, estate tax exposure, most of our clients are setting up, life insurance over in a trust, and then you have the estate tax benefits, and the tax-free equivalent on the internal rate of return on those policies are pretty compelling, when you look at, and then when you start to embed in some guarantees, on that policy. It really comes down to really the planning and, of required capital for a client and excess capital, for gifting over to a trust and what they don't need. And then obviously at those higher tax brackets, you have tax exempt, interest. You always do the calculation between taxable and tax exempt, but just did it the other day with a client, and it's obviously a true winner at a 30% bracket, and and then going up to 39.6 in 2026. So this is my own creation. Sorry for a lot of data on there, but I liked that, looking at like single versus married filing jointly. And next year I'll clean it up a little bit better because some of these numbers are a little fuzzy. But what I wanted to put in there was, as you go up those brackets, you can see the 3.8% net investment income tax applies to a married filing jointly over $250,000, and that's in the 24% bracket. Where it applies to a single taxpayer is, at the 32% bracket over $200,000 a year. And it's a reminder over on the left-hand side, that the capital gains rates. So 0% capital gains rates between 0 and 12%, 15% capital gains between 22 and 35% brackets. And then you don't get into the 20% capital gains bracket until you're at the 37% bracket, so which is pretty meaningful for most of our clients. So you'll get copies of all these slides, and I think that slide is probably one of my favorites. So feel free to print it out, laminate it, put it on your desk. It's just a good reminder of a couple of different things that applies to clients. Here's a slide that you kind of all know about, but I like the grid here of talking about capital losses, and the best way to use capital losses, is against, is using like long-term losses against short-term gain, and then where there's a neutral effect, and then the ineffective is using a short-term loss against long-term gains. So sometimes we don't have control about that, but it's just a good reminder as to the capital gains, applications. And I think with our clients that have, large like capital gain events, it's just good to take it into perspective, with those clients. One of the things that I don't have control over is the dog's barking, and I can see out of the corner of my eye, the dog is looking out the window and is getting ready to bark. So I apologize for that in advance. So with business owners or with our employee clients, this is just kind of a reminder that with them to make sure that they're maximizing, with a business owner, like maximizing their qualified plan funding. So, what do I mean by that? I mean, they could have, was on a phone call with a client the other day, an anesthesiologist who's, W-2 income, but also has 1099. Okay, the 1099 is coming through a Schedule C. Maybe what we should be looking at is setting up an entity, possibly like using an S corporation, saving on some payroll taxes, expands the opportunity from a Schedule C to have different types of plans with the S corporation, and then additional funding, for that business owner, and catch up contributions over age 50, into those plans, and coordinating it with the W-2 funding plans that they have. So, just kind of like looking at clients, reminding them, you're in December. They have, they have taxable income, maybe bracket management, maybe they weren't aware or didn't think of this was the year that they turned age 50 to do their catch-up contribution. And if they have the ability, maybe they can fund it through a bonus, if it's through payroll, like a bonus coming through, or increase their percentages to a large amount just for like the next few pay periods. And little wins like that make big, added up together, make big wins. I like this slide because it includes, you don't realize how powerful health savings accounts are. And, but when you look at, 401k plans, traditional, been around for a long time, right? Contributions are tax deductible, investment growth is tax deductible, and the withdrawals, you pay taxable income. Then introduce the Roth IRA. You don't pay the tax on the contributions going in. And but then the investment growth is tax free, and then the withdrawals are tax free as well. And then this the health savings accounts, you have the benefit of getting it's not a huge amount, but it's you get the benefit of tax deductible on the contributions. Investment growth is tax free, and the withdrawals used for qualified expenses are tax free as well. And that's going to apply to a lot of our clients that have high deductible plans. And so with those high deductible plans, with a family in 2023, it's $7,750, for the year. And in 2024, that's, with index, I think the index amount for 24 numbers was like 5.3%, which was lower than the indexing for 2023 numbers, which I think was at like 7 or 8. I don't have the number in front of me, but it's still meaningful because it's a lot higher than what we've seen on average for the last 10 years. So $7,750 is a home run for clients with high deductible plans, making that contribution. They can set that up, now to the end of the year. Even they can make a 2023 contribution, I think through their April 15th, through the deadline of, and set up that account and make the 2023 contribution. So that doesn't even have to be done by year end. And then, so just a reminder on the standard deduction, that was increased, pretty much doubled, maybe even more. I don't remember, but it was significantly higher. But you took away kind of like other benefits, right? And kind of, remember the, less application of alternative minimum tax. But we're really where that standard deduction made a difference with a lot of our clients, were a lot of them now are not, while the standard deduction is that high for married filing jointly at $27,700, they're not itemizing their deductions. So you start to get into conversations about, yes, I'm going to talk about bunching. So bunching strategy. So we've talked about in the past, I love using donor advised funds. I think they're great. So donor advised fund gets the AGI tax limitations of a public charity. So cash into the donor advised fund is 60% AGI limitation. Appreciated securities is 30% of AGI. So and the nice thing about like a donor advised fund is, as you talk to clients about it, they can set it up through, like, we'll set it up through our custodians. We have 3 different custodians that we work with, that, between Fidelity, Schwab, and LPL, different donor advised funds that are on those platforms that I personally used, with clients, and they're cost effective. The minimum is not that high, and it varies with the different donor advised funds. But the nice thing about it, so the key things is clients can call it whatever they want. They can. So I had a client the other day, they named their donor advised fund after the wife's grandparents, because the wife's grandparents, really the wealth for the family, really came from the wife's grandparents, and they wanted to acknowledge, where it came from. Other people, call it, just, after their favorite type of tree or bird, or use their family name. It's just, and besides, calling it whatever you want and making it feel like a private foundation without all the complexity, you also have the benefit of using a donor advised fund for like small grants with children, once, or grandchildren when they're old enough, and talking to clients about those types of opportunities and the explanation of family wealth and where it came from and the importance of charitable giving is meaningful conversations. I think, especially like this time of the year. So I like the use of donor advised funds. I think that they're underused, with I think there could be a lot more charitable planning that's done with clients. And I think a lot of times we just don't take the time to have the conversation. But from a bunching standpoint, you have the ability for a client who doesn't itemize their taxable deductions. The bunching's point is like, your itemized deduction of $27,000. So unless you have deductions that are over $27,000, it's not beneficial. So charitable giving, let's say you give $5,000 of charitable gifts, per year. If a client can afford it, maybe they take the next 10 years of charitable gifts, they put it into a donor advised fund that's $50,000. They itemize that 1 year, and then they go back to using the standard deduction in the next years. And then those assets are in the donor advised fund, to be used and distributed to charities, when they decide, and to which charities they decide. So the other nice thing about it is they don't have to decide on day one which 501c3 charities in the US are going to receive it. That's a limitation on donor advised funds for clients that are looking to give to non-501c3 charities and or to international charities. The donor advised fund is not going to accomplish, those goals. So also, in addition to bunching, let's say, for example, a client has a huge, income tax year for, selling an appreciated asset, a business, real estate, concentrated position in stock, whatever it might be, and they're in the 37% bracket, but typically on most years, they're in a 24% bracket. So you take $100,000 funding, into a donor advised fund where they typically give $10,000 a year to charity, then the tax savings over 10 years is meaningful. The strategy number 2, where you funded the donor advised fund in year 1 and the highest tax bracket is $37,000, where in the in the strategy where they just funded it each year, it was $25,000, which is a difference of $11,700. So it's just, again, just conversations that we should be having, with our clients. I like this slide because it goes through. It's a great slide to put in front of a client, talking about the difference of gifting appreciated stock, for example, with either a 50% basis or a 0% basis, and or giving cash. So, for example, the over here gifting cash, the benefit of the deduction is $3,700. They're gifting $10,000 to charity or donor advised fund, right? So the benefit of that deduction is $3,700. The effective cost of that deduction is $6,300, and they're assuming the tax brackets are like 37%, tax rate. But then let's say that they give stock, and let's just skip the 50% basis, but let's go over to 0 basis, because why not make the comparison more compelling? So benefit of the embedded tax avoided is $2,300. Right. So that's the difference between giving cash. I think a lot of our clients, we can speak to them about numerous things and from a tax standpoint, but sometimes they're very visual, and using an example like this with them to kind of go through the differences and the additional benefits, of giving stock versus cash makes a big impact. So giving, a stock at a 0% basis, the effective cost of the donation is $3,900 versus $6,300. So that's meaningful. All right, here I wanted to get into qualified charitable distribution. I remember when it first, when it was first available to clients, and I'm like, why would a client do that? Like, just like it didn't hit me at first. And then I think it's because the number was so high at like 100,000, and and because each client can give $100,000, from their personal, IRA. So married filing jointly, they can give 200,000, but the 100,000 needs to come from each one of their separate IRAs. These are permanent, so those are not going to be reverted back in 2026 or repealed or go away. And so here's the benefit. Here's where I think that it makes sense, and it makes sense for all of our clients. That makes sense for all of our clients that are at required minimum distribution age. They have required minimum distributions that they're taking. They make charitable gifts throughout the year. And so, for example, if you have a client that, their required minimum distribution is $40,000 and they give $2,000 to charity, right? So here's the opportunity right now. They have some charitable gifts that they have remaining. They haven't fully taken their RMDs for the year. Then why not distribute the 2,000 to their charitable organizations directly from the IRA? So therefore being a qualified charitable distribution. And then the balance is 38,000 comes out as taxable income from the RMD from the IRA. So really the benefit there, they're not itemizing and they are not taxed on the additional 2,000, and it's a better tax situation for them. So I know a lot of you are probably doing these with your clients, but again, it's just a reminder that, this is a great opportunity to talk to them about. Roth conversions. So I've heard other presenters kind of like, Ender strategists kind of talk about Roth conversions, and we talk to our clients, all the time about the ability to use Roth conversions. And I like to look at it and talk about it as like a micro conversion. So it's not converting the whole account at once, but is there an opportunity from a bracket management standpoint, where it makes a lot of sense is where you're in the 12% bracket, maybe you push up into 22 or 24% bracket, and then kind of like managing those brackets, and then also taking into consideration the section 199A threshold, especially if it's a service business. So kind of taking a look at those different thresholds and where it makes sense for a client to, again, go back to one of the earlier slides, setting up some of those Roth accounts for the future where they're not pulling all of their money just out of the traditional taxable IRAs. This slide right here is just really, when you look at the difference between a traditional IRA and a Roth IRA, nothing, if you consider everything stable, everything's the same, no assumptions change now and in the future, the tax situation is the same. You have a traditional IRA at $1 million balance, it grows at 200% growth until death. Account balance at death is 3 million. The income taxes that apply at 40% is 1.2. The ending balance is 1.8 million. Okay. On the Roth side, you just pay the tax early for the same amount of growth and same tax rate now and then. It's 1.8 million. But life is not like that, right? So life has changing circumstances, and especially for business owners, when you look at whether they should fund the Roth or a traditional IRA, you have that qualified business income deduction at least now for the next 2 years through 2025. So, and that's a 20% reduction on the taxable income for the business. That's and then differences in tax rates now and a time of distribution. Those factors have to be taken into consideration. So with the business owner with the 20%, maybe it makes, as long as it's not the service business pushing them out of the threshold of qualified business income deduction, maybe it makes sense to have the Roth contribution and take that 20%, deduction on the federal side. All right, so income smoothing strategies, that's a great way to kind of look at a charitable remainder trust. Big picture for 10 seconds, charitable remainder trust is a trust that's set up for the benefit of charity and for your client. And typically where it's set up is usually to a client that wants to sell an appreciated asset. We've used them with our business owner clients for the sale of the business. We've used them for concentrated stock positions, for real estate, and there's a charity, but there's an amount that goes to charity at the end of the term is 10%. And a lot of times I like to tell clients, you have to be charitably inclined for charitable strategies to really work. But sometimes they even work with, especially if you're in a high income state and you can smooth out that income and the client's actually moving to a low income state or a no income state at a later point in time. Sometimes the charitable distribution of 10% at the end of the term doesn't even matter, and it makes it a better tax play and income smooth, for that client based on those assumptions. I'm not going to go into a lot of details here, but this slide is has a lot of points on there, which you'll have it for your reference. But really, when you make a distribution then from a charitable remainder trust to the client who set it up, it's basically the thing to remember. It's worst first. So the worst taxable income comes out for the annuity or the unit trust payment first, and then you don't get to tax-free income or return of capital until after the worst taxable income is paid out. Earlier, I talked about like state income taxes and how it makes a big difference. Colorado, you're not so bad at 4.55%. And so a lot of states are actually putting into place, different tax rates, especially millionaires tax. So in the state of Massachusetts, where it's a 5% tax rate, there's an additional 4% that's taxed to our taxpayers, that are over $1 million of taxable income. So there's different tax strategies that we started to use, with clients. And one is an incomplete gift trust. And then incomplete gift trust is just a way to have the clients be a beneficiary of that trust, but also have access to those trust assets, as beneficiaries, but, doing in the right timing and using a distribution committee in that trust. Obviously, I'm not going into a lot of detail on it right now, but it's a way to mitigate and reduce down that state income tax exposure. And you have a client that transfers, let's say $10 million, of $10 million of gain into that trust. And then the following tax year, that asset is sold. And that, you be at 10%, state income taxes, where in the state of Massachusetts, 5 + 4, that's pretty meaningful. So 10% of 10 million is $1 million. So let's say 900,000 in the state of Massachusetts. That I was talking to a client the other day, and he's like, Rich, you and the team, you've already saved us hundreds of thousands of dollars, millions of dollars in taxes. I can't believe you're coming up with another strategy. So, and that's what all these things kind of like build onto each other, and it builds goodwill with your clients. I just want to go into this just really quick on the AMT side. With our executive clients, one of the things that I've seen is a lack of planning with incentive stock options. Every year, I know you guys know this, guys and gals, is that there's an exemption for AMT. With our executive clients that have incentive stock options, we should be planning and utilizing that AMT exemption where it makes sense, so that it kind of mitigates that AMT exposure when that stock goes public or really appreciates in value, and the incentive stock option invests in the employee, and they have that alternative of minimum tax that's going to apply to that incentive stock option. And then, section 199A, this is a great chart for you guys to kind of refer to, whether it's the deduction applies and whether it's a service business. You've probably seen it before. This is a slide that's been out in the industry since section 199A came out. It's just a great one to kind of refer back to. And then here, this is just quantifies the difference where, remember before, all variables the same, keep the tax rates the same at 35%, right? But in the Roth IRA, make it taxable now, but apply the QBI deduction to a business owner, and all of the variables the same. The Roth 401k contribution was more beneficial because of that 20% deduction. And unless we have a congressional change, that QBI deduction is going to go away in 2026. So the next piece that I wanted to talk about was in a sale. I know we're running short on time. I have a minute left. So with the sale of a business, different strategies that we utilize, a charitable remainder trust, qualified opportunity zones, section 1202, stolen sale, incomplete gift trust. And I'm just going to go to my summary slide right now.
Rich, we can also move into a question or two if we have time. I'm not sure if we do or not. Daryl, you can let us know.
Yeah, I want to say one more thing is like, put together this. This is a summary of everything kind of like talked about here, like most of the things where there's a problem, there's a solution. And so refer to this chart when you're talking to your clients and just, you don't have to have all the answers, but just talk to them about the different solutions and they'll be your biggest fans.
Yeah, I think we have like a minute, so I don't know if there's a way, can we just, if I share your emails out, people can ask that, just send you for follow-up questions. Is that okay with you two?
Yeah, that's
That's
fine.
fine. That's fine. There was one quick question. Do we want to answer it on a? Can they take a
Sure.
QCD off of a inherited IRA if they're not in retirement age?
Oh yeah. So I'll have to look up that one, but I think a QCD has to come from your account. There is a required minimum distribution from an inherited IRA. That's actually whether you need to take the RMD from an inherited IRA in year one, or you defer the whole payment to year 10. That's been a question that's been out there for a while now. And there's different, I think different practitioners have different ways to go about it, whether you have to take the RMD or you just wait and take the full thing in 10 years. So based on that, I'm going to give a qualified answer and say that probably not.
I think
Because
you're right. A
that
lot
part
of
of it,
people are tuning in. I think it's 70 and a half. I think you're right. So
yeah.
there's a few other people. Um, but yes. So everybody, thank you. Daryl, thanks for having us here. And Rich, you always represent Integrated so well, and we so greatly appreciate it. Again, if anybody has any questions around what we do and how we do it and how we partner with CPAs around the country, we're always here. I think Daryl is going to share our information. And Daryl, I'd love to get that background. That's just
Ah,
so
I'll
season
send,
appropriate.
I'll send it your way, John. Yeah, thanks everybody. That's first session of the day. Just so you know, there will be a follow-up email after all of the sessions with more information about how to get your CPE certificates, and we'll have connections to all of our people. So for those of you, I'm sorry, we there was so much information to cover that if you have questions, connect with Rich and John, and they'll be happy to answer your questions. And it will also, that follow-up information will be included in the email that you should see tomorrow, if not first thing Monday morning. Thanks, everybody. We'll be back
Thanks
on
for
here in a
having
few
us.
minutes.
Take care. Enjoy the break.